How's it going, everyone? My name is Jamie Bateman, and I want to thank Fred and Tracy and their team for inviting me once again to be one of the speakers of the Cash Flow Expo. I can't believe this is the eighth one already. They were definitely out in front of the virtual event thing for sure. Let's dive right in. So we do mortgage note investing at Labrador Lending, and that's our primary focus. It's a niche within real estate investing, as some of you may know. I've been in the residential real estate space for quite some time. A little bit more about me in a minute or two, but today I get the opportunity to share with you something that's taken quite a while for us to figure out, to be honest with you, is you know, as we've developed a client avatars for our business, I've realized that investors tend to fit into one or more one or more avatars. So we're going to dive into how to discover your investor avatar. We're coming at this from the mortgage note investing perspective, but you can absolutely apply this to different asset classes, whether within real estate investing or not. So this is going to be a guide to finding the mortgage note investing strategy that aligns with your goals, lifestyle, and experience. And once again, I want to thank Fred and Tracy for the opportunity. Here's your standard disclaimer. None of what I'm about to say is should be considered legal or financial advice. I'm not an attorney, an accountant, or financial advisor. I'm not pretending to be any of those things. You can read the rest of this disclaimer. This is for educational purposes only. I'm not going to read this slide to you. This is more about me. I obviously want you to know that I know what I'm talking about. I certainly don't know everything, but I have some experience in the residential real estate investing space. I've been a residential real estate investor since 2010. Served in the military, have been an entrepreneur for quite some time, and I'm out of Maryland. I primarily have experience in when it comes to real estate investing in the rental property space, and then in 2018, really switched my focus over to mortgage note investing, and that's really been my focus for the last 8 years. Still have a rental portfolio. I'm still a fan of rental properties, so I can talk about that as well. But we have more information on our website about me and my team. So, why your investor avatar matters? Well, not every investor is the same, and not every investor fits into one box or investor avatar. I think one thing, people get excited about, what maybe you watch this cash flow expo, you watch many presentations, you get excited about picking an asset class or a strategy within real estate investing or some other cash flow opportunity, and you forget to consider, and I'm guilty of this myself, forget to consider your own avatar. So you get so focused, it's very easy to get focused on an asset class or a strategy, investment strategy. That may be great for someone else, but does that fit your situation? I think we don't take the time often to really evaluate where we're coming from in our own investor avatar. So why your avatar matters? Well, it relates to your investment goals. Are you seeking passive investments? Are you wanting to build a scalable business that you actively manage, or something in between? One thing that really gets overlooked quite a bit is, okay, what do you bring to the table? Your background, your deal experience, your financial knowledge, all of these dramatically influence which strategies you're best equipped to execute successfully. And considering your experience and skill set, what you bring to the table, and focus playing to those strengths will drastically increase your odds of being a profitable investor. Absolutely, it's something to consider. Is if you've been in real estate investing for 20 years, that matters quite a bit. Or if you've been a financial advisor for 20 years, that matters quite a bit. We see a lot of engineers come into this space. We see people from lots of different backgrounds come into the mortgage note investing space. Well, it really helps to focus on what you're good at and play to your skills and strengths. How much time do you have? How much do you available time do you have to devote to this? Do you want to spend your time and energy, working on scaling a business or even actively managing, say, 10 mortgage notes? Or do you want to be truly hands off? These are just factors to consider when building your investor avatar and why these factors matter. And then lastly, your level of control. Do you want to let go of control? Do you need that control of every little decision when you're building this portfolio of mortgage notes? Or are you open to delegating operations while you maintain oversight? Or do you fully trust the professionals to essentially you hand over your capital and look for a return? There are a lot of, we're going to go through three different avatars here, but these are things to consider when building your avatar and defining your investor avatar. And these are factors that really matter and can help you really lead you to success or failure. Let's go over the passive investor avatar. So this person values a hands-off strategy, not participating in the day-to-day active management. Um, Last year, I did a presentation for the Cash Flow Expo, the 2025, the seventh Cash Flow Expo, and we went over the spectrum of passiveness. So it's related to this presentation, but we went through many different ways to be a passive investor and many different ways to be an active investor. So I just wanted to highlight that. Um, Feel free to reach out if you'd like a link to that presentation. But if you're a passive investor, you're likely a busy professional, or maybe you're retired and don't have the energy to deal with all the details. But oftentimes these are busy professionals with capital to invest, but they have limited time or desire for day-to-day active management. You truly want a passive investing opportunity. You value your time over the highest return possible, so you are likely going to give up some return upside, and but you value your time more than that, and you're comfortable delegating to proven experts. You're focused on income or profit generation, not just income. Oftentimes, this is profit at the end of a deal, end of a fund, etc. But you're not focused on deal sourcing and day-to-day management. You really want to be hands off. Your priorities are passive investments, limited day-to-day involvement. In other words, not talking to lawyers, servicers, or other vendors. You value your free time, you value your energy and your focus. Maybe you're killing it in your W-2, or you have another business that is bringing in a lot of income. Why in the world would you take your focus off of that if that's going well? So you have other sources of income that are doing well for you. My advice, not financial advice, but my advice would be to focus on what's working and let others add an additional source of income for you. So what success looks like for the passive investor avatar, this person who fits this avatar, your capital works for you while your time stays free. You have professional management handling execution and oversight. So I've talked about this before. Running a mortgage note business, we're going to get into this a little bit. It really comes down to three things. It's sourcing capital. This is for the active manager of a mortgage note business. Sourcing capital, sourcing deals, and then managing the capital and the deals. It's three legs of the stool. Well, when you're a passive investor, you're handing over your capital to an active investor, and you have a lot less control, but you have a lot less work and a lot fewer headaches for sure. So the trade-off is you give up control, you give up that individual deal selection and direct control in exchange for convenience and professional management. This is best for investors seeking a return without the time commitment and without the energy and effort that's required for active management. All right. At Labrador Lending, we've recently defined what we're calling the hybrid investor. We used to serve the active investor and the passive investor, and we've more recently come up with this term called the hybrid investor. There's nothing fancy or formal about the term. It's just someone who doesn't fit neatly into the active or passive investor avatar. So, who is this person? They want control without the operational burden. They still want strategic decision-making authority. They want to have that control of their portfolio, but they don't want to track taxes and insurance on non-performing loans. They don't want to deal with all the headaches of asset management. They don't want to deal with vendors, borrowers, attorneys, yeah, all tracking taxes, insurance. Like I said, they don't want the day-to-day management. They don't have time. They don't have the energy, but they want to maintain that control. They are an investor who wants control, but doesn't want to manage the day-to-day. They value having direct ownership and decision-making authority over the assets in their portfolio. And again, this can apply to mortgage note investing. It can apply to rental property investing. For example, do you hire a property manager? Well, if you want more control, you don't. If you value your time and sanity, you do. So again, we're coming at this from the mortgage note investing perspective, but this applies to different asset classes as well. So the hybrid investor, and there are other ways to be clear, there are other ways to be a hybrid investor than what we're speaking about here. But this is the angle we're taking for this specific presentation. There are many, it's one of the things I love about real estate investing in general. There's so many ways to skin the cat. But the priorities for this hybrid investor who we're focused on today, they want to own their individual mortgage notes directly. They want to select which geographic markets and strategies they're going to apply, markets that they're going to focus on, strategies that they're going to apply. Are you interested in performing notes, reperforming notes, notes in bankruptcy, firsts, seconds? What states are you going to buy in? Well, if you're a passive investor, for the most part, you're not making those day-to-day decisions. You really don't have any control over the notes owned in a portfolio that you're investing in. And we're going to get into specific ways of being a passive investor. When you're a hybrid investor, you still are able to make those strategic high-level decisions. You maintain decision-making authority, but you avoid the operational headaches. So you capture most of the upside potential, but you are paying someone to do that asset management for you. So you're not going to capture all of the upside potential as a hybrid investor. Okay. But you still maintain that oversight. And then last, you prioritize your focus on other sources of income. So again, maybe you have a high paying W-2, maybe you have a strong business, outside of mortgage note investing, but you want to build this mortgage note portfolio on the side, or you own mortgage notes and you're tired of doing the day-to-day management. Why put all your time and energy in asset management when you can focus on your other business, your other source of income, and you can outsource that asset management? So what success looks like, you build a customized portfolio aligned with your specific criteria, while professionals handle the servicer coordination, vendor management, and operational details. Again, tracking taxes and insurance, making sure that you have forced place insurance or homeowners insurance on the property, which is the collateral. That's a key thing that can really cost you if you're not careful. There's a lot of minutia and details to track when it comes to specifically non-performing notes, but even performing notes. The trade-off, you stay involved in key decisions and strategy, which requires moderate time investment compared to fully passive investing. You pay for professional asset management services, but you do maintain ownership and control. So those are some ups and pros and cons. That's some of the benefit and some of the trade-off. This is best for busy professionals or even retirees who don't want to work a full-time. You don't want to build a scalable business and spend 80 hours doing mortgage notes. Busy professionals and retirees wanting ownership with professional support. All right, the active investor, I'm going to pick up the pace here. We've got a bunch of slides to get through, and I know there's a lot of valuable content that I haven't covered yet. The active investor avatar, of the three, obviously this one requires the most time, and you value ownership, control, decision-making authority, and the ability to scale intentionally. You prefer direct, active management, shaping strategy and outcomes yourself rather than relying entirely on delegation. So this is typically the person, oftentimes they're younger, they have time, energy, maybe they don't have as much money and they need to go find a capital partner. And oftentimes that's the active investor. They have some capital, some skin in the game, but they have time, energy, willingness I mean, day-to-day time, free time to put toward this every week, but also time looking across, they're younger, so they have more time to build a scalable business. So it doesn't have to be that you don't have to be younger to be an active investor. And there's a lot of gray, there's a lot of in between, like I covered last year. But the active investor prioritizes control, skill development, ownership, scaling a business. They value unlimited earning potential, and they're willing to trade time for the highest possible profits. They also value doing the active management. What success looks like, you control your own notes, you decide what you buy, you run the whole thing. You can certainly outsource many different aspects of the asset management and capital management, but you're in charge and the buck stops with you and you're doing the day to day. So pros and cons to that for sure. You invest significant time learning, analyzing deals. Some of the people I'm mentoring now, they've been surprised at how difficult it is to build out those sources of notes in the beginning, build out that deal flow, and uh, you invest lots of time doing that, learning and then building relationships. As much as AI is a huge factor in all of this stuff, it's not going away for sure. We're using AI quite a bit in our business. Relationships are really what matter. And this business is a relationship business. Um, and so you need to spend time. If you're going to be an active investor, you need to spend time building out those relationships, going to conferences, networking, having phone calls, meeting people for coffee, whatever it is. And the upside with becoming an active investor is you have the highest possible returns. The downside, or maybe it's an upside, depending on your perspective, is you have more responsibility and a steeper learning curve. This is best for DIY investors seeking ownership, experience, skills, decision authority, and the ability to scale intentionally. I'm going to fly through some of these because I think I'm going to be running short on time here. Comparing the three avatars, you can see these three columns: passive, hybrid, and active. The passive investor, I'm not going to read every one to you, but you can see there are different core desires, different time commitment. And these are ballpark numbers, by the way. This is just to put some numbers down so you can see what we're talking about here. The return potential is certainly lower as a passive investor versus an active investor. And it makes sense. You should be rewarded for putting more time and effort into something. Um, and then you can see the who this is best for, the avatar down at the bottom of each column. All right, the due diligence pivot. Um, a key educational distinction between these three roles is what you're actually auditing before you invest. So as a passive investor, your primary focus, let's say you've decided you want to invest in mortgage notes. You've already determined the asset class. Your primary focus is doing due diligence on the manager. Check their track record, talk to other investors, talk to other sponsors, other people who do what this person does. Um, do a background check on this person on the team, and that's as a passive investor, you're handing your capital and control over to someone else. I'm focused on when talking about this, I'm thinking about mortgage note funds specifically for passive investors, and your focus should be on doing diligence on that and research on that operator, that manager, that sponsor, that GP, whatever you want to call them. For the hybrid investor, you're doing due diligence on specific assets because you're the one buying those assets, and then you're relying on asset management service to handle the operational day to day. For active investors, you're also doing due diligence on those assets, uh, So when you're buying your own notes as a hybrid investor, both hybrid and active, you're going through your due diligence process. You're evaluating the borrower, the property, and the paper. The payer, the property, and the paper, the three Ps, as you may hear people talk about. So your due diligence process on the asset is actually really similar for a hybrid and an active investor. Um, but as a hybrid investor, you're also needing to do due diligence on that asset management team that you're entrusting to do the day-to-day asset management. So, which avatar are you? Ask yourself these questions. You're likely passive if you want to increase your portfolio without day-to-day operations. You trust professionals to manage your money. You value your time predictability over maximum returns. You have other priorities competing for your time. You're likely hybrid if you want to choose your own investments. You want that control, but you don't want to manage the day-to-day paperwork. There's a ton of paperwork in this business. You value transparency and direct ownership of the notes. You're willing to be moderately involved, and you're likely active if you want to build a scalable business, even if that means scaling to four performing mortgage notes. That's still an active thing. As much as you'll hear gurus talk about note investing is mailbox money, blah blah blah. No, not once you start to scale on any level. There's still a lot of work. It may not be physical labor, but there's a lot of work if you want to be an active investor. And you also value unlimited earning potential. Um, you know, is it really infinite? No, but it's the highest, has the highest upside of these three on this slide here. So you prefer hands-on control and active management as an active investor. So one thing I want to note, and this we have this at the bottom of the slide, your avatar is not necessarily permanent. You go through seasons in life, things can change. Maybe your financial picture changes. Maybe you were unemployed for 5 years and now you just took a job. Well, maybe you need to move more toward the passive side of things if you were active, right? So it can change throughout your life, and also you can fit into more than one category at the same time. I am currently invested in multiple mortgage note funds, my own fund as well as others, and I'm very much an active mortgage note investor. So I don't really fit neatly into one of these three avatars. We are simplifying things to help you with your decision making process. So, common evaluation pathways. Many investors transition between avatars, like I was just saying. You may go from active to hybrid. You may go from passive to hybrid. You may go from hybrid to active. And again, you may fit into more than one avatar at any given time. There is no best avatar. The best one is the one that fits your current season of life. And like we talked about, what you bring to the table as far as energy, time, money, and experience, and your goals. What are your goals? So lots of things to consider. And again, these are just ways that people can transition across different avatars. Ways to invest passively in mortgage notes. One is invest in a mortgage note fund. We run the Integrity Income Fund. We've run that for over 3.5, coming up on 4 years now. We've never missed a monthly distribution. This is for accredited investors. This is not a sales pitch for my fund. There are many other great mortgage note funds and other passive investing opportunities as well. Hypothecation. We're not going to go into detail on any of these strategies, but where you loan capital to an experienced note investor and they use their performing note typically as collateral, and you get steady interest income without really managing the note. It's pretty passive. Purchasing partials is a little more active than hypothecation, but still can be fairly passive. And then joint venture partnerships where you are the capital partner, not the day-to-day manager. Um, that's another way to be a passive investor with mortgage notes. I would say a mortgage note fund is the most passive that I'm aware of. And then hybrid, uh, we don't have a specific slide in this section for how to invest as a hybrid investor. This is where we're highlighting asset management service, where you have that control, but you're outsourcing the asset management. Ways to invest actively in mortgage notes: purchasing non-performing notes, creating notes. So maybe it's seller finance notes. You took back a property and then you sell that property on terms. managing joint ventures as the operational day-to-day manager, and managing a mortgage note fund. Managing a mortgage note fund is certainly very active. I went over the three legs of the stool earlier, so I won't belabor the point. The spectrum of passiveness, this really is based on, excuse me, comes from the presentation I did last year and a blog post we wrote, and it's also in our 74-page free ebook on labradorlending.com. There's a spectrum, okay? So not, these are not these categories, these avatars. You can see here, even when you call yourself a passive mortgage note investor, well, like we've covered, there are multiple ways to be passive. We just want to show here that there are many different the many different parts of this spectrum. It's not clean little separate buckets. So you can be very passive investing in a mortgage note fund, or you can be very active by managing joint ventures or a mortgage note fund. And then somewhere in the middle is that sweet spot of that where that hybrid investor falls, and they may hire an asset management team to do the day-to-day research. I'll be quite honest, I'm not sure where this research comes from. I can check with my team. You can reach out to us if you need that information. But you can see here time based on well, I'll just highlight this key finding. 67% of investors cite lack of time as the primary barrier to active real estate investing, making passive fund structures increasingly attractive. You can see on the right side of this slide, the investor preference analysis. It revealed that 32% prefer complete control, 41% want strategic control. That's more of the it's more of the hybrid investor. And 27% prioritize complete hands-off, a hands-off approach. This is from Alternative Investment Industry Trends from 2021 through 2024. But again, if you need more information about that, feel free to reach out to us. One of the industry insights is that the hybrid model is the fastest growing segment, increasing 156% over the last 3 years as investors seek a middle ground between passive and active strategies. You can see here we have a case study. This is someone, her name is Beth. It's a little bit hard to read the way the slides turned out when I saved them to PowerPoint, so my apologies for that. That's on me. We have an investor, Beth Matthew, in our Integrity Income Fund. And I'm not going to read the entire slide to you. She's a busy founder and CEO and entrepreneur. She values work-life balance. And she needed a hands-off investment to support her lifestyle and add an additional stream of income in this case. So her solution was to put $100,000 into the Integrity Income Fund through her self-directed IRA. She set up auto monthly. We do automatic monthly distributions from our fund, and she's received over 21,000 in income, and she spent really 0 hours other than grabbing her K1, Schedule K1 once a year to send that to her CPA to prepare her tax returns. Maybe a question or two for us along the way. Very minimal time commitment. And again, as a CEO and entrepreneur, her time is very valuable, and she likes real estate exposure and consistent returns. And it's completely hands off, and it works well for her. And again, there are many other fund options. Not pushing my fund. These are just what we know from our experience. And again, these slides, I apologize, it's overwritten a little bit, but this is Andrew Smith. He's an LLM model trainer. And he's an Integrity Income Fund investor. In the interest of full disclosure, Andrew worked for us, and he actually helped me create the Integrity Income Fund. So is he biased? Yes. But at the same time, after he stopped working for us, he put capital into our fund, $100,000 with a preferred return of 10%. So that says something about the fund and the fact that, and our team, the fact that he was willing to put capital back into the team he left. Thank you, Andrew. Anyway, he hasn't been in the fund for too long, so you can see the details there. He's a parent with a young family. And they've had some health concerns, and I'm not overstepping here because Andrew has shared this publicly, that required him personally to be extremely involved as a father and involved at home. And so he needed additional income because he was not able to maintain a W-2 through the last, say, 6 years. He needed a passive solution with predictable cash flow, and that's what he's been able to obtain. You can read that there. Case study. This is completely hypothetical. This is someone, Mike Thompson, who was an active investor, but then pivoted to hybrid, the hybrid investor, and hired an asset management team to do the day-to-day management for him. He had built a $500,000 note portfolio over 5 years, managing 12 notes, but it was consuming about 20 hours per week dealing with servicers, loan servicers, attorneys, borrower workouts, tracking taxes and insurance, doing the books. That's something people forget. That takes time as well. You're monthly, you should be reconciling your books, and then annually, obviously, filing your taxes and whatnot. That all of this takes a lot of effort. Like I said, managing finding capital, finding deals, and then managing the capital and the deals. Well, the solution was that he transitioned over to our asset management service. And again, this is hypothetical. This is not a real person. And he continued sourcing deals and doing due diligence and purchasing the deals himself. And then he acquired 12 additional mortgage notes, which freed up a lot of time. He acquired 12 additional mortgage notes with the freed up time. I'm sorry. And his portfolio grew from 500K to 1 million. He maintained decision-making control on all key matters, and he improved his portfolio performance because he now had a professional team really focused on that asset management. You can read his hypothetical, theoretical quote there. This is a real person, Peter Halliday. He's a great guy. He's an AI leader with a proven track record of building teams. He's a software person, and I mentored Peter, and I think he had some other mentors as well. I still mentor him sometimes. He still schedules calls with me, but and he expanded from 7 notes to 25, purchasing 18 since he started the mentorship program. We have an active mentorship program for those active investors who either want to start out or they want to scale and take their business to the next level. And he's launched Halliday Investments. He's done very, very well. In Peter's own words, the mentorship program gave me the confidence I needed to accelerate my goals. It helps provide an experience and perspective to help navigate from a person that's farther along. So I don't know everything. My team doesn't know everything. We can usually introduce you to someone who does. There's a chance I've come across, this question before. If you have a question, so Peter's alluding to the fact that I'm a little bit further along than him, and so it gave working with me and my team. It gave him the confidence to scale. The mentorship program is also about people and connections. So our program, not trying to oversell it by any stretch, but a lot of the value in our program comes from getting plugged into our network, and we can introduce you to different people in this space. It's not necessarily the specific knowledge transfer in a mentorship session, although I like to think that's valuable as well. Another case study, Jeff Vincent. I'm not going to have time to go through every word on this slide. Jeff has 10 plus years in real estate investing and has learned a lot along the way. And we were chatting in a note Facebook group, the Good Deeds Facebook group, which has since changed. It's now the Paper Trail Facebook group. Chris Seveny runs that Facebook group. Anyway, Jeff and I were apparently corresponding a good bit back then, and he went through my mentorship program as well. And we ironed out his buy box and we lined up sources of notes, and he's since closed on a couple of different notes And in his own words, the coaching and mentoring was just what I needed to help get off the starting line and get a few deals completed. You can read the rest of the quote. We don't have time here. I'll be reaching out to Jamie to help work out the details as I go through that phase of the business. So again, there are a ton of great courses out there, books, groups you can join. Our mentorship program is an hourly thing. I like to think it's corresponds well, pairs well with a course. But we also do have an online community that we're building. But there are many other great programs out there, not just Labrador Lendings. It's very important that you trust and respect the person you're working with. Um, so I wouldn't recommend all gurus or mentors, but there certainly ours is not the only one out there. Um, I think that's just a duplicate slide about Jeff. And then performance analysis by avatar type. You can see the stress level is very low on the passive side, assuming you trust the operator. And then the return level is a little bit lower. And then on the active side, the return potential is higher, it's highest, and the stress level is highest. It makes sense. Hybrid falls in the middle for both. And here are some common misconceptions that we debunk here on this slide. Active investing always beats passive. Passive investing means giving up all control. You can't switch between avatars. Hybrid is just for indecisive investors. More time invested equals better returns. You need to start active to learn. There's no one size fits all solution. Every situation is personal and different. That's why when I meet with mentees, for example, I like to learn about where they're coming from and where they're headed, because I can't tell you, maybe mortgage notes is not for you. There are pros and cons to everything. Mortgage notes have cons. So, even deciding to be a mortgage note investor, whether passive, hybrid, or active, that should take some analysis and decision making. It doesn't, mortgage note investing is not the only way to make money in real estate investing or any other, there's so many ways to do it. And that's, um, I think what you've been exposed to through this cash flow expo, this eighth cash flow expo, there are many different awesome paths to success and making money in alternative investing, not just the stock market like we're all familiar with. Um, you can see it's a little bit more about my company and me. And then we have a solution for the passive investor. That's for accredited investors. That's our Integrity Income Fund. I highlighted that earlier. We have not missed a distribution at the preferred return levels in the almost 4 years since we've operated the fund. We've recently launched our asset management service at Labrador Lending, and that is for the hybrid investor. And then we also have our mentorship program, which I've been doing for probably 4 or 5 years, maybe longer. And that's primarily one-on-one mentorship along with our new online community. Really appreciate you taking the time. Check out our website, labradorlending.com. We have a ton of free guides. We have a foreclosure reference pack, which breaks down per state the approximate time and costs to foreclose in each state. We have a state licensing guide. We have a 74-page ebook on mortgage note investing, an AI PDF, which is about how to use AI and how to find more mortgage notes. Tons of blog posts. We have a YouTube channel. And then again, you can go to labradorlending.com, click on investors, and you'll see a guide that'll help you choose which path of these three may be right for you. So I really want to thank Fred and Tracy again for the opportunity, and thank you all for watching. Thanks for spending your most valuable resource with us, and that is your time. Thanks, everyone. Appreciate it.